Have you ever noticed that a business can look like it's booming on the outside, but when you look closely, the actual profits just aren't hitting the bank? In business, the most basic formula we all learn is simple. Profit equals revenue minus expenses. You take the money a company made, subtract the money it spent, and you get what it keeps. Sounds easy, right? But here's the catch. In a real business, expense is almost never a single line item. A company has dozens of different types of expenses, from raw materials to rent to wages to insurance. If you just lump them all together into one giant expense bucket, you have no idea what is actually eating their cash. That is exactly why learning to read an income statement is one of the most important skills you can develop if you want to find good companies for investing. Understanding this document is the ultimate cheat code for investors. It doesn't just tell you how much money a company made, it reveals exactly how efficient their operations are, where they are bleeding cash, and whether their underlying business model is actually built to survive long-term. In this video, we are going to learn how to read and build an income statement, and we are going to do it step by step through a real-world example. Let's say you run a neighborhood coffee shop, and last month was your best month yet. Your register says you brought in $30,000. You feel rich. But looking at that top number is a dangerous game. Let's run the numbers and find the true profit. For our coffee shop, let's say you brought in exactly $30,000 last month. On a detailed income statement, you won't just see one number here. You'll see it broken down into exact line items: espresso sales, food and pastry sales, retail merch like branded mugs, and maybe even catering. But you don't get to keep all of that. First, we subtract the direct costs to make those specific drinks, your cost of goods sold, or COGS. Again, we get specific here. Your COGS line items will list your roasted coffee beans, dairy and alternative milks, syrups, wholesale pastries, and packaging, meaning every cup, lid, and sleeve. It also includes your direct labor. Direct labor is the money you pay to the people physically making your specific product. For our coffee shop, these are the hourly wages of your shop floor baristas. Their time is directly tied to producing the coffee you sell. Let's say all of these raw materials and direct labor costs total $9,000. Subtract that $9,000 from your $30,000 in revenue, and you are left with $21,000. This is your gross profit. It proves that your core product makes money, but we still have a lot of bills to pay. Next, we have to pay your operating expenses, or OPEX. These are the fixed overheads you pay just to keep the doors open regardless of how much coffee you sell. A detailed OPEX section spells out everything. Under facility, you have line items for your store lease, electricity, water, waste removal, and internet. Under payroll, you will see a line item for salaries, which might make you pause. You might be asking, wait, didn't we just include labor up in COGS? Yes, but we have to include salaries here in OPEX as well because they are fundamentally different in nature. Up in COGS, you had your direct labor, the baristas directly tied to making each cup. Here in OPEX, we have your indirect labor. This is the cost of paying the people who manage and support the business as a whole, like your store manager or a part-time bookkeeper. They get paid their fixed salary whether you sell 1,000 lattes today or 0. Then you have your tech and admin costs, your Square POS subscription, QuickBooks software, commercial music licensing, general liability insurance, cleaning supplies, and equipment maintenance. Let's say all of these everyday cash expenses total $12,000 for the month. When we subtract that from your $21,000 gross profit, we are left with $9,000. In the finance world, this specific $9,000 checkpoint is a big deal. It is called EBITDA, pronounced EBITDA. That stands for earnings before interest, taxes, depreciation, and amortization. Why do investors love EBITDA? Because it shows the raw cash-generating power of your day-to-day operations. It ignores how your business is financed, what your local tax rates are, and the accounting rules for your equipment. It just asks, does this business model generate cash? In our case, yes, it generated $9,000. But we aren't done. While EBITDA is great, it ignores the fact that your assets are slowly losing their value over time. This brings us to the D&A in EBITDA, depreciation and amortization. What is the difference? It all comes down to what you can actually touch. Depreciation applies to physical, tangible assets. You bought a $15,000 commercial espresso machine to open this shop. It takes a beating and loses a little bit of value every single month. We have to account for that physical wear and tear as an expense. Amortization is the exact same concept, but applied to invisible, intangible assets. If you paid $5,000 upfront for the trademark rights to your coffee shop's name, spreading that cost out over time is amortization. For our independent coffee shop, we are mostly dealing with physical gear. Let's say your machine and furniture depreciated by $1,000 this month. When we take our $9,000 EBITDA and subtract that $1,000 in depreciation, we are left with $8,000. This number is EBIT, earnings before interest and taxes. It is also commonly known as your operating income. EBIT is the true final profit of your business operations before the bank and the government take their cut. Finally, we have to pay the piper. First comes the bank. You have a small business loan and your interest expense line item for the month is $500. Subtract that from your $8,000 EBIT and you get $7,500. This is your EBT, earnings before tax. Last up is the government. Your income tax expense isn't just a random number, it is calculated as a percentage of that EBT figure we just found. Let's assume your business has an effective tax rate of 20%. To calculate your tax bill, we simply multiply our $7,500 EBT by 20%, which comes out to exactly $1,500. We subtract that $1,500 in taxes from our $7,500 EBT, and we finally reach the bottom line, net income. Your final net income for the month is $6,000. You started the month with $30,000 at the top line, and you ended up with $6,000 at the bottom line that you can actually put in your pocket or reinvest into the business. That is a solid 20% net profit margin. By breaking down your income statement into checkpoints like gross profit, EBITDA, and EBIT, you don't just see what a company made, you see exactly how their business works. If this breakdown helped you understand your numbers, hit the like button, subscribe for more business breakdowns. See you in next video.